the things that make sense for you. Let's look at stock number 1, American Express. Now, they're working hard to attract new, high-spending cardholders around the world and are focusing on building stronger digital tools to keep their users engaged. They also expect to make more money from credit card fees, which have already been growing a lot, big part of their long-term strategy. Analysts project Amex will grow its earnings by 12 to 16% in 2026, showing confidence in the company's plan to keep expanding. Guess what? I don't care what they're going to grow or lose in earnings in 2026. I care about, is this company going to be around for decades, and are they going to make considerably higher money decades from now than today? And the third most important thing is, can I pay a rational price today for that? So now we need to go run this through our stock analyzer to determine a price we would pay for American Express. So, $245 billion market cap, a lot of enterprise value. That difference is debt. Well, they're holding people's money. There's a lot of money out there, et cetera, et cetera. These credit card companies and banks tend to have this big difference. But like I said, $19 billion in free cash flow last year, selling for 13 times their free cash flow. Revenue growth. Guys, keep in mind, their net acquisitions in the last 5 years are only $500 million. For a $250 billion company, that's nothing. This is all this growth right here is all organic growth. 11.5% a year for the last 3, 13% a year for the last 5, 8% a year for the last 10. Has it been a booming economy? Yes. Our community holders, our community members have this as a hold. Now, 8 pillars. I'm not worried about the debt. PE ratio, significantly higher than the 5-year price of free cash flow. I don't really think I think this is actually an 8-pillar stock essentially. Yes, the debt is high, but it's understandable based on the kind of business it is. So let's go to analyst estimates. Analysts don't actually have much in terms of growth for the earnings per share. 1760 growing to 22. Not much growth over the next 3 years. Look at revenue. Not much growth here. 9%, 8.5%, 3, 7. But guess what? With a company with such large margins, how much margin exactly? Let's look at this. They have like an A for gross margin because it's basically all profit there, and they don't really attach a cost of goods sold. It's very well known. Who's the competitor to American Express in the high-end card? I can't name one. That's what I like about them. Everybody knows you have American Express lounges. You have lounges you get into just for having an American Express. There's that elitism to it, and that is valuable. So I put in 20, 23, and 26, and my 9% desired return. I hit the analyze button. And guys, I have a low price of $480, high price of $1,078, middle price of $720. Now, starting in 2026, PayPal will be the first payment processor to be built directly into ChatGPT, giving over 800 million users a way to buy things right inside the app using PayPal. It could be 3, 5, and 7. Actually, I'm going to change that to 3, 5, and 7. Let's go a little bit lower. Let's be a little more conservative, even though I can make that up in my desired return. Profit margin and free cash flow. Again, I'm focusing on free cash flow here. 16, 19, and 22. Now, what's the PE to apply 10 years from now? 16, 19, and 22 as well. And then my 9% market return, just to see what's the intrinsic value of the business. That's all I'm trying to find out here. I have a low price of 87, high price of 200, middle price of 133 based on discounted cash flow, and based on earnings, a low price of 71, a high price of 145, middle price of 102. This is why people in our community love it. It's a company that's still growing, but the perception is it's not growing. I look at that thinking, okay. I look at PayPal and I'm like, this is a good business. People trust PayPal. That's important for me. And when it's selling for a discount, that's when it gets interesting. How much of a discount? Less than 10 times free cash flow. I like that a lot. So for a company like PayPal, I'm going to still stick with it. And at some point, as they buy back shares, earnings per share goes up, free cash flow per share goes up, the market will see the value. And by the way, about PayPal, great comment made by Tim. He uses PayPal for all his subscriptions because I said to him, you're right, because it's so easy to cancel them when I want to cancel them. He's absolutely right. All right, third company, Generac, the final stock that I own. Generac used to just focus on home generators, but now they're becoming a major energy tech company with 2 big growth plans. First, they're going after the booming data center market by doubling their large generator capacity and aiming to make over $500 million in revenue from that space by 2027. Second, they're working to fix and grow their clean energy segment like solar and storage by focusing on profits and cutting costs. they're also still benefiting from more power outages and weather problems, which keeps demand strong for home backup power. Analysts, who, as you know, I don't always agree with, expect Generac's earnings to grow over 15% in 2026. But look at this. Return on invested capital, 5 years, 9% over the last 5 years, 8% over the last 1 year. Not very good. So this is a business, even though I think they're the leader in generators, I look at that return on capital and go, I think maybe it needs a discount to value. Let's see what analysts estimate. $8.50 per share this year, going to $12.80. That's about a 50% increase in the next 3 years. And revenue growing at 11, 9, 8, and 6%. Okay, so nothing to write home about, but let's see what is going on here for Generac. So I did a 10-year analysis, 4, 6, and 8% revenue growth. I did 9.5%, 10.5%, and 11.5% profit margin, thinking their profit margin and free cash flow would increase over time, especially with this new business model they have. Now, PE and price of free cash flow. So they had 10.5% return on capital in the last 10 years, but it's declining. I'm actually going to change my mind on this 15, 18, and 21. I'm going to call it 13, 16, and 19. I'm not really feeling that. And my 9% return, I hit the analyze button. The stock's currently at 155. All right, I have a low price of 106, high price of 220, middle price of 155. So guys, I look at this going, okay, yeah, this is not making much sense to me at current prices, but I can be patient and wait for it there. So guys, the honorable mention I have is Adobe. Guys, look at this company. Just got downgraded today. It's at 305. Its all-time high on Adobe was $700 back in 2021. Since then, let's go look at the revenue. 2021, they did $16 billion in revenue. Last year, they did $23 billion. And the stock is down how much? Over half. They did profit in 2021 of $4.8 billion, $7 billion in the last 12 months. The stock is down over 50%. It just tells you that you just got to be patient for the right time to buy, okay? And let's do the stock analyzer real quick, because I just did it today on Adobe. Let's pull it up. Guys, I'm not going to tell you all my assumptions. I'm just going to show you the stock's currently at 305 and look at these values. I have a low price of 382, a high price of 820, middle price of 560. It generates more free cash flow than net income. And I think people are overplaying the whole AI issue.
All right, well, let's get to those small cap stock picks this week. Your first pick is Sensata Technologies. Tell us about it.
Yeah, I mean, they're a supplier of sensors and electrical products, mostly for the transportation market. Yeah, the stock trades at a 28% discount, enough to put it well into 4-star territory, has a 1.4% dividend yield. We rate the stock with a high uncertainty, rate the company with a narrow economic moat, really be based on switching costs and intangible assets.
Now, I was looking over Morningstar's analyst report on Sensata, and it sounds like this one's a turnaround story. So tell us about that and why you like the stock today.
Yeah, so here in the short term, when you look at the automotive markets, heavy vehicles, the industrial end markets, all of those have been, relatively soft. If you look at guidance, revenue also looks like it's going to be soft, this quarter as well, probably a slight decline, in revenue. But, we do have a new management team that's in here. They're much more focused on profitability and really generating free cash flow here in the short term. That has been working. We're seeing improvements, in both, from kind of that long-term perspective. For the market overall, or their specific market that they compete in, we're just looking for that slow but yet steady secular trend in autos towards electrification, more efficiency, higher connectivity. So all of that should be a good tailwind for the company, over the longer term. From an investment perspective, we're looking for a combination of improving growth and profitability over the course of this year, probably more in the second half of the year. We expect that the company should be able to maintain their dividend while still supporting a pretty healthy balance sheet. What I like here is we've got good momentum in the stock. It's up 22% over the past 52 weeks, yet still undervalued. And if you look at our model, it only trades at 9.5 times our 2026 earnings estimate.
All right, well, your second pick this week is Terex. Run through the numbers on it.
So it's a 4-star rated stock, trades at a 26% discount to fair value, 1.2% dividend yield. We rate this one with a high uncertainty as well and a narrow economic moat, that narrow moat being based on the company's switching costs and intangible assets.
Now, it looks like Terex is a company that Morningstar dropped coverage on for a while, but then picked up coverage again during the fourth quarter of last year. So why is this a small cap company that Morningstar does choose to cover, and why do you specifically like it?
So the company makes equipment for construction, infrastructure, and waste management. And I think one of the things here that really helps support the company is it has a top 3 market share in each of the product categories that it competes in. Now, there's definitely some noise going on here. They are undergoing a merger. We expect to see some significant cost saving synergies over time. So I think that's part of the investment thesis here. And they also noted that they plan on divesting one of the slower growth parts of their business, the aerial platform business. So that's another way that we think that they're going to help free up economic value for investors. This is another one where it's had very good momentum. It's up 20% over the past 52 weeks, yet still a 4-star rated stock at a pretty good margin of safety. Only trades at 10 times our 2026 earnings estimate, yet we still expect double-digit earnings growth through 2029.
All right, and your final small cap stock to buy is Mosaic. Give us the highlights.
So it's a 4-star rated stock at a 21% discount to fair value. Nice healthy dividend yield here at 3.2%. Rate this one with a high uncertainty. And unlike a lot of our other picks, this one actually has no economic moat.
All right, now Mosaic stock is up more than 14% already this year, yet it still looks undervalued. So give us the story on this one, Dave.
Yeah, so Mosaic is one of the largest producers of phosphate and potash, of course, two of the nutrients that you need for crops. Now they have had some pretty weak volumes, relatively low crop prices, really have kept the amount of fertilizer that farmers use relatively low. But like anything else, you can only scrimp on fertilizer application so much for so long. So we are looking for a modest rebound here in 2026. Got to keep those nutrients in the soil really to be able to maximize crop production. I think the market is still expecting weaker application this year, so a bit of a differentiated view here in the shorter term. Now this one, the stock is definitely up off of its December low, so it looks like there's some good momentum going into this year on this one. Again, trades at only, I don't know, I think it's like under 12 times our 2026 earnings estimate, so pretty modest valuation in my mind. Yet we're still looking for above 10% earnings growth through 2029 as well. And I also like this one too. I've seen a lot of commodities. I mean, not just the metals, but a lot of other commodities look like they've bottomed out, are starting to move higher. So in my mind, I think this one could be a good play in your portfolio if we're starting to enter a commodity super cycle.